Chapter 5, Itemized Deductions. So we're going to start talking about itemized deductions in Chapter 5. So the first one is medical expenses. So medical expenses are deductible to the extent that they exceed AGI by 10% now. So that means first, your medical expenses have to get to 10% of AGI, and then every dollar after 10% is what really is deductible on your Schedule A. So taxpayers can deduct the itemized deductions of medical expenses, net of insurance proceeds for themselves, their spouses, and their dependents. You can't deduct it if you're already getting a tax deduction through contributing through your HSA or at your work. It's only things that you pay for in after-tax dollars. The qualifying relationship must exist on the date the expenses are incurred or paid. And for the taxpayers that are over 65, from 2013 to 16, it's 7.5% of AGI. That's because it was adjusted to be 10% of AGI when it used to be 7.5%. Taxpayers may deduct just about all medical expenses that are doctor prescribed. So expenses that relate to the maintenance of general health are usually not deductible. For example, if I buy over-the-counter medication, not deductible. My going to the gym, not deductible. But if I was prescribed physical therapy, deductible. If I'm prescribed if they write me a prescription for a medical device, a wheelchair, any of those things, that is deductible. A deduction may only be claimed for the medical expenses that are actually paid, regardless of when the care was provided. Basically, it's only so if I have a medical bill and it's $10,000 and I don't pay it this year, I can't deduct it. I can deduct it when I pay it. Medical capital expenditures are deductible only to the extent that they exceed the fair market value of the increase in the property. This is like if I put on a handicap ramp or something. If it adds to the value of my house, then I can only deduct it if it exceeds what it adds to the value of the house. Also, transportation costs for medical purposes are deductible. Includes such items as a cab, bus, train fare, or auto expense, which there are medical miles. So if you have to drive, I've had clients who had to drive to Boston for treatment weekly, and therefore they get medical mileage for the transportation cost. Premiums for long-term care insurance are deductible, but the extent to which is dependent on the taxpayer's age. So in the book, it'll tell you the taxpayer's age and the limits for long-term care deductions. The next deductible on your Schedule A are the four main categories of deductible taxes on a person's return: personal property tax, local real estate tax, other state and local tax, and foreign taxes. Taxes that most individual taxpayers deduct on a Schedule A are state and local income tax and property tax on real estate and personal property. Personal property tax is like your excise tax on your vehicle. So, real estate taxes are deductible in the calculation for federal taxable income. If the tax is paid on a personal use real estate, such as a principal residence, you put it on a Schedule A. If it's not paid on a personal residence, it would potentially go on a different schedule. Also, personal property taxes are on personal use assets, such as a car or a motor vehicle, a boat, or something like that. There could be a personal property tax on that. For a property tax to be deductible, it must be based on the value of the property, and it must be levied on the personal property, and it must be imposed at a minimum on an annual basis. Lots of people ask me in Springfield, can I deduct the trash fee? That's a tax. It's actually a fee, and it's not based on any property value, so it's not deductible. An individual can deduct the amount of state income taxes actually paid, whether through withholdings. So this is, for example, if you take your W-2 and at the bottom it says Massachusetts, and then it says wages, and then it says, I don't know, $1,500 withheld. That $1,500 goes on your Schedule A as personal income taxes. However, if you received a state refund the following year for taxes you deducted the prior year, the refund must be included as taxable income. This is called the tax benefit rule. For 2014, taxpayers can elect to take itemized deduction of an amount either of the state and local income tax or the local general sales tax paid during the year. So usually state and local income taxes is more, so you would always choose whichever is more. But in the example of New Hampshire, they don't have state and local income tax. So potentially you would go with the general sales tax. Or in states with no tax, they would take the sales tax deduction if they paid sales tax. The amount of sales tax can be determined by calculating the actual sales tax paid during the year. Another way to calculate it is using the sales tax tables provided for you in the IRS instructions for Schedule A. An additional option would be to use sales tax deduction calculator on the IRS website. When using the sales tax tables, taxpayers determine their sales tax based on their income and number of exemptions. So they calculate a standard deduction for you for sales tax. Foreign taxes paid. The majority of the clients that I see that pay foreign taxes in their investment portfolio, and it would be listed with their 1099 divs or 1099 INTs, and it would just say foreign taxes paid. There are other options, but that's the majority of taxpayers. Taxpayers have the option of taking a credit for the foreign taxes paid or deducting the taxes as an itemized deduction on their Schedule A. Most people take a credit. Individual taxpayers are generally better off using the credit rather than the deduction because a credit is a dollar for dollar reduction in taxes. So, when property is sold during the year, only the seller is allowed to take the deductions for taxes paid. This is false because when property is sold during the year, it'll be apportioned to the seller for the time that they had it and to the new buyer who will own it for the time that they had it. So, tax-deductible interest. So this is like your mortgage interest. So interest paid on a home acquisition loan or a home equity loan secured by a qualified residence is deductible up until certain limits. So, for a home acquisition indebtedness, the interest is deductible only on principal amounts up to $1 million. So if your principal is more than $1 million, then your interest becomes non-deductible. And then for home equity deductibleness, the interest is deductible only on principal amounts up to $100,000. So if you take out anything more than $100,000 on a home equity, only the interest on the first $100,000 is deductible. Points are paid. Points are prepaid interest that you pay to obtain a mortgage. Each point equals 1% of the loan principal. For example, Marissa pays 2 points on a $100,000 mortgage. The 2 points equals $2,000, or 1% times 2 times 100,000. Typically, taxpayers deduct points ratably over the term of the loan. However, the law allows an exception for points paid in connection with a principal resident. Most people take the points deducted over the life of the loan. Often individuals who purchase a home with less than 20% down are required to pay what we call mortgage insurance premium, or PMI. For mortgage insurance premium contracts issued in 2014, the taxpayer can take an itemized deduction for the amount of the premium paid in 2014 on line 13 of your Schedule A. The provision was extended by the Tax Increase Prevention Act, which temporarily extended some expired tax breaks for individuals and businesses in 2014. It still potentially might happen in 2015. Investment interest is any interest paid or accrued indebtedness properly allocable to property held for investment. The deduction of the investment interest expense is limited to the net investment income for the year. If the investment interest expense exceeds the investment income, the non-deductible excess can be carried over for future tax years when net investment income is available. A charitable contribution deduction may be claimed on an itemized deduction on a Schedule A. So the amount of the deduction depends on the type of the donated property and is subject to AGI limits. In order to be deductible, the donation must be cash or other property value. Depending on the nature of the item contributed, and there are three deduction limits for charitable contributions. which are 50% of AGI, 30% of AGI, or 20% of AGI. So for charitable contributions that are public charities are limited to 50% of AGI. The way you know if it's a public charity is they'll have a 501c3 status. And then there are 30% AGI applies to contributions of a capital gain property. So this is if you donate cash. This is if you donate capital gain property. For example, you donate a building to a charity. And then there's a 20% for donations of capital gain property to a private foundation. So again, some type of equipment, machinery. They're very specific about vehicles. It's hard to take a deduction for vehicles. Generally, if appreciated, capital gain property is donated to a publicly charity, the deductible donation is the fair market value. A key exception applies to the rule of personal property, and the vehicle is personal property. If donated property is put in an unrelated use, the contribution must be reduced by the amount of any long-term gain that would have been realized if the property had been sold at fair market value at the time of the contribution. So what they don't want people doing is passing a vehicle that's, let's say, not working or something, donating it to a charity, taking a big write-up when it's not even useful or can't be used by the charity in that way. A second exception occurs if you've only held the investment property short term. In this case, the deduction is limited to the tax basis of the asset, or the cost, not fair market value. The donation of the investment capital gain property is also subject to additional limitations depending on the type of organization. The substantiation requirements for charitable contributions have become more stringent, and taxpayers are subject to greater reporting requirements. So most of the increased requirements are borne on the nonprofit organizations. For taxpayers' perspective, if it's less than $250, you could use a canceled check or a receipt. If it's over $250, you need acknowledgement written receipt from the organization that you donated the money to. And these are talking about each contribution. And contributions above the limitations can be carried forward. So if, let's just say I donated $10,000 this year, but I only had AGI of 5, I can carry forward my excess contribution for up to 5 years. If non-cash gifts are worth more than $500, the taxpayer must file an 8283. This is true. An 8283 must be filed, and this explains what the name of the charity, the type of non-cash gifts that you donated. Most of the time I see this as donations to Goodwill, and you must list the date and information about that charity so that there's more stringent requirements to this. Deductible casualty and theft losses. I'm going to read what this is, but this won't be covered on the exam. A casualty is defined as an identifiable event of a sudden, unexpected, or unusual nature. Sudden means the event is not gradual or progressive. In order to claim a deduction, the taxpayer must own the damaged property. So I think about, there's a thunderstorm and a tree falls and your roof collapses because of the tree fall, and not all of it is covered by insurance. So the taxpayer's loss is calculated by the uninsured loss. So you can't deduct what you get reimbursed, but let's just say you don't get all of it. Then you can deduct what isn't covered by the insurance. In general, the casualty loss is the lesser of the fair market value immediately before the casualty, reduced by the fair market value immediately after. The amount of the adjusted basis is determined by the loss from the sale or other disposition of the property. Typically, a taxpayer reports a casualty loss on the tax year that it took place. However, there are instances where the casualty loss may be deducted in different tax years. Sometimes this is a theft loss, or reimbursement by the insurance company, or otherwise negligence claims against an individual caused the loss, or technically disaster area losses. So I think about the tornado. That was a disaster area loss, so we had claims. But most of the time, I don't see too much of the casualty and theft losses. So in order to be deductible, the amount is limited to the first. Each separate casualty is reduced by $100. Second, it must be in excess of 10% of AGI. So first you deduct $100, then you figure out what's over 10% of AGI, and then you can calculate it. And then the next category that we have is miscellaneous items. The sum of all miscellaneous item deductions must exceed 2% of AGI before you receive any deduction. Unreimbursed employee expenses is usually the largest and most likely cause to the total miscellaneous exceeding the 2% floor. These expenses are costs incurred by a taxpayer as a part of his or her employment, which are not reimbursed by the employer. If any travel, meals, or entertainment expenses were incurred, or some expenses were reimbursed, then the taxpayer must complete a 2106. So imagine I drive to a conference for work, and they only reimburse me 30 cents a mile, but IRS is 55 cents. I could put the difference in mileage on my 2106. One deduction that is often missed is taxpayers' tax advice. If a taxpayer has a large portfolio, the advisory cost can be deducted as a 2% miscellaneous cost. So there are limitations. So you can add up all your Schedule A, and you would take this deduction instead of your standardized deduction if it adds to more than the standardized deduction. But in the case of high income earners, a taxpayer in the past, a portion of the itemized deductions has been forfeited. This effectively increases the tax rate of high income individuals by denying deductions rather than increasing rates. The high income limitation was phased out from 2006 to 2009, but it's back in effect for 2014. If the taxpayer's AGI is above a certain amount, they limit the itemized deductions. And that's an overview of itemized deductions. So you need to finish reading Chapter 5 and do the homework assigned in the class.